Hi, everybody. I'm Jeff Barton, and welcome to 2022. I missed last week. A lot of things going on at my own house. Personally, as well as professionally, there is many things going on both here as well as in the marketplace. So let's get right to it. 30-year fixed rate loans. Everybody knows the loan rates have jumped big time. A year ago, it was about maybe 2.5%, 2.8%. Right now it's 3.64% for a 30-year fixed rate loan, 15 years at 2.87. That's still a pretty good deal. FHA's at 3.25. That's always a good deal. Jumbo loan is at 3.29, and again, that has come up some. We were stuck in the low teen, 3.13, 3.17 for half the year last year. It's gone up now, probably continue to go up, but again, these are not conventional, nor are they agency loans, so that's a different marketplace entirely. The 5/1 arm is at 3.82, and that number is really going up. I guess there's risk in that 5/1 arm, and they want to get their money in as they get closer and closer to the adjustment period. Let's a couple other things in the news to use section. The labor force participation rate is at 62%. Pre-COVID, 63%. So we're really, when you say, when you hear people say that the unemployment rate is down, it's down because of the participation rate. But at the same time, there are still 10.5 million jobs being unfulfilled, and the quit rate is huge. I think we had almost 4.5 million people last month quit. Now, apparently, in a tight labor market, that's a good thing because people quit one job to go get another one. Let's see what happens. Obviously, the tight labor market has brought about a ton of inflation. That's part and parcel to the free money that's going around. We're seeing, as in California, a number of state legislatures get into the act either by raising the minimum wage or by raising salaried employees, what they call non-exempt employees, by setting a tiered system for which the employer has to pay a salary based on their work and job description, somewhat similar to what the hourly wage people are. Anyway, I've been caught up in it myself. It's a good thing. People deserve more money, and it's tough to live on what we have been paying them for years. So I'm sort of neutral on the issue, but these are some of the things that are driving inflation. When people make more money, things cost more because you have to charge more for your services or for your product in order to have enough money to pay your employees. That's just the way it is. Now, obviously, there are other inflationary pressures, but to me, that's the big one, and that's the one that you can't solve. And that's the one that I think what will happen in a tight labor market is you will continue to see inflation rise. A lot of people are looking to inflation rise a little more before it gets a little bit better. We'll have to wait and see. FHFA hikes fees. Yes, the high balance loans and the second homes are all getting their fees hiked. There are a lot of things that are going up which aren't necessarily good things, but are triggered by the fact that things cost more in general. So fees by government agencies on loans have gone up and probably will continue to go up. We don't see FHA going up. We'd actually like to see the reverse, but we'll have to wait and see what the FHFA oversight or the Purse Secretary there, Sandra Thompson, does about it. Let's see, Wyndham, Better.com, and Interfirst, all companies which are direct-to-consumer loan companies, are laying people off. Refinance boom is over or is about to be over. Many of these people who are looking to refinance are going to do so because they want cash out of their properties. But in terms of lowering interest rates and lowering payments, that's not going to happen unless you bought like back in the Stone Age and your rate was in the 5s or 6s. Most people have already refied out. The only reason to refi now is the cash out, and it may be better to get a second mortgage on that than to lose that terrific interest rate you have. But there's always ways to do it, and the refinance people will still be around, but these companies are showing us that that particular way of business and that business model is going to suffer for at least the next few years just because interest rates are rising. The taper rate rise, the balance sheet adjustment, all of these things are what's causing rates to go up. The interest rates are dependent on the 10-year. Everybody looks to the 10-year for the interest rate hike. And the 10-year went up today. Let's see where we are at the 10-year, 1.77. Now, that's a big jump. We're almost at 2-year highs on that. We'll probably see that in the 2s, not in the too distant future. Actually, the rates are rising quite a bit faster than we would have thought they were. We were thinking that at the end of the year, they would be at anywhere from 3.75 to 4.0. But we're already at 3.64, and it's January. So, yeah, where are we headed on those rates? It's all due to the Fed not really keeping their eye on the ball, or whatever you say. God knows I didn't know, and a lot of people didn't know. But there are four things that the New York Fed Governor Dudley said that were mistakes made by the Fed, especially during the early part of COVID. One was setting a framework as the 2%. They had set the 2% or higher inflation framework as a way by which we could gauge what the economy could tolerate, knowing that both inflation was coming, but setting the sights above 2% was really the wrong thing to do, according to Dudley. Number two was misjudging the strength of the labor market, and that's what I talked about in terms of driving inflation. Number three is inflation was transitory. It's not. Number four is too gentle communicating with the markets. When the markets were, we were all worried about the second taper tantrum. We weren't really expressing to the markets what was going to happen when we were raising rates. And some people are calling for 4 times this year. Wow, I've talked way over what I'm supposed to. Anyway, I'm Jeff Barton. This is the Mortgage Minute. Thanks very much.